If you watch my channel, you know I do a lot of talking about infinite banking, whole life insurance, and personal finance in general. Now, when it comes to infinite banking, if you look around social media, all the different platforms, there's a lot of conversation about how positive arbitrage is kind of quote unquote the unsung hero of infinite banking. And that's where people get confused about what infinite banking is. Now, I'm a huge believer in utilizing properly designed whole life insurance for the uses that most people are talking about when they're talking about infinite banking. So in this video, what I'm gonna do is I'm gonna break it down and make it really, really simple when we're talking about whole life insurance, talk about the two different stages that you have to go through when thinking about utilizing whole life insurance in your life to enhance your personal finances, to make every decision you make with your money more efficient, because that's what it's all about when you're talking about taking over the banking function of your life. A lot of people think you could just out of the gun start banking right away with your policy, but the bottom line is that's not the case. So in this video, I'm gonna show you the two different stages where most people are gonna start, what you need to do to get to ultimately where you wanna be and start earning that positive arbitrage, and ultimately all the kind of variables that go in the policy and things you have to consider when building that policy. So if you haven't already, make sure you subscribe and hit the bell, that way you're notified every time I launch a new video. Let's go. Hey, what's going on, Cashflow hackers? It's Chris with Life 180, and I am here in the Dominican Republic. I'm gonna be working down here for the next 3 weeks, doing my video content from here. You're probably gonna get a completely different vibe while I'm down here, checking out our investment properties, checking out, I'm doing, I got a lot of really fun things happening down here. We got a couple houses, investment properties that we're getting completed in the next 3 weeks or so. A lot of really positive things happening. So I'm gonna be down here, and a lot of my content is gonna have a different vibe to it because I'm gonna have some beach stuff, and it's just about me figuring out where am I gonna create this content and what setting and whatever. But at the end of the day, the content's gonna be what it is. It's all gonna be focused on the stuff that I think is important, that's bringing value to you when it comes to understanding whole life insurance, understanding infinite banking, understanding ultimately how to build your financial foundation in your life for more success for yourself, right? That's what it comes down to. And so in this video, I've been inspired kind of to talk about infinite banking, and I was inspired through a conversation that I was having with a professional colleague, and we were talking about kind of where infinite banking is misrepresented in the marketplace, where infinite banking is kind of misleading, where a lot of social media influencers are misleading people, telling you that you can get positive arbitrage with your banking policy. Now, I think one of the things that is really important to understand, and where I want to start with this, is kind of taking a step backwards and realizing, like, what is the purpose, right? So let's say I was talking to you for the first time. My question to you is not going to be, do you need an infinite banking policy, or how are you going to use your infinite banking policy in your life? I'm a real big believer that you have to align your money with your values and beliefs. And infinite banking is not right for everybody, because not everybody is going to utilize the policy the right way. So one of the things that I kind of take a step back on, and I want people to think about is, do you believe, and this is the question, the first question, do you believe that you need an emergency fund? Most people are going to say, yes, I do believe I need an emergency fund. Because if you don't believe you need an emergency fund, well, I got news for you. You're going to be in a lot of trouble at some point in time in your life. You got to be able to prepare for the ups and downs of the world around us, and the economy and the market cycles and all these different things. And ultimately, not just be prepared to protect yourself, but be prepared to take advantage of opportunity that kind of blossoms in those environments, right? And so that's a really important thing. Now, that said, if I say, hey, do you believe you need an emergency fund? You're gonna say, yeah, most likely. And then I'm gonna ask you, well, how much of an emergency fund do you believe you need? And you're gonna tell me 6 months, most likely, because that's just the common belief of people in the personal finance space. And I think that's because people like Art Williams back in the day, Dave Ramsey, Susie Orman, they just kind of say that that's what you need. I'm a big believer we need to be going deeper than that. We need to be asking why. If you say it's 6 months, well, why? Why is it 6 months? And when I look at statistics and I look at the average amount of time it takes to get a new job is 1 month for every $10,000 of income you earn. Well, that means if you earn $60,000, well, an emergency fund to hold you over for, 6 months, if it's $60,000, that's 1 month for every $10,000 of income. That's going to get you to 6 months. Okay, I could see that happening, but once again, then that's only average. I don't ever want to just be prepared for average. I want to be prepared for more than average. And so I would encourage you, there's a lot of different variables to consider, and I'm not a believer in just cookie cutter statements like, yeah, you need 6 months of this, or you need 10 months of that, or you need 10 times income for life insurance. Like that is just, it's really half-baked advice that is not gonna serve you meet your goals, and it's not gonna help you align your money with your values and beliefs. And so if you believe you need an emergency fund, then the next question goes, well, if I need an emergency fund, where am I going to save that money? Where's the best, most effective, efficient place to save that money from a long-term perspective? And, you know, I'm filming this video, it's May of 2023 right now, and there's a lot of things that have changed in the last 6 months when it comes to the life insurance space and the fixed market space, right? Like a year ago, I could talk about the fact that whole life insurance would outperform your savings account and this and that, whatever. And now you can literally take your money and put it into a savings account, and it's going to outperform a whole life policy on a short-term basis, right? But the problem is there's a lot of elements in a whole life policy that you're going to get that you do not receive in a savings account. So sure, in a whole life policy, you may be able to get 4 to 4.25% right now, and net in your whole life policy, long term, you're going to get 4 to 4.5%. Now that seems like, why would I put my money in a whole life policy instead of this savings account where it's even more liquid? And in a whole life policy, I'm going to lose, say, 10% liquidity right out of the gate to implement this and invest in this long-term strategy. Why would I want to do that? Well, it's because of a lot of reasons. A, you're going to get life insurance, which most people may not even need it, but there's a lot of reasons you're going to want it. You're going to get living benefits forever, which is a great thing to understand when it comes to the buy term and invest a different strategy that people like Dave Ramsey and Susie Orman and Art Williams and, you know, the Primerica people of the world kind of talk about. When your term insurance ends, you have no living benefits at the end of it, and ultimately you probably have no living benefits for most term policies anyway. So the ability to have living benefits and access to your death benefit while you're alive for medical needs, for long-term care needs, for if you become disabled, critically in need of medical help, you have access to these benefits while you're alive. And this is something that most people don't think about. Like, I'm 40, right? Like, I don't need it now. I don't anticipate needing it now, but I certainly know that while I'm alive in my 60s, 70s, 80s, there's a likelihood that I'm going to need that. So that's a reason you can't, I always kind of tell people, you can't solve long-term problems with short-term thinking. And so I would argue that putting your money in a whole life policy is a long-term thinking. Your savings account is short-term thinking, and the whole life policy is the place that's going to enable you to kind of have your cake and eat it too. You're going to be able to put that money in there. It's maybe not going to be quite as liquid on a short-term basis as a savings account, but from a long-term basis, it's actually going to be more liquid. It's going to outperform that savings account, and it's going to follow the fixed rate environment a bit more. And so historically speaking, it's going to outperform that savings account. Now, of course, savings accounts are performing better now because rates have gone higher, and we're kind of in this weird interest rate environment. The Fed doesn't know what they're going to do right now. There's a lot of uncertainty in the economy in a lot of different areas. And I think savings accounts right now are kind of benefiting. But at the end of the day, the rates that these banks are having to pay on these savings accounts are also putting stress on the banks. And that's why a lot of these, people like Jamie Dimon are saying that he expects 180 banks this year to fail alone. And that's why, right? And so here's the deal though. Let me kind of get back on track here. With whole life insurance, and when we talk about the very beginning of this and infinite banking and arbitrage and all these things, when does a whole life insurance policy become a banking policy? Because now if we go back to this and we say, all right, we know we need an emergency fund, right? Where are we going to save that? Well, let's just say, for the sake of this, and I've got other videos that'll bring you down on why, and that go much, much deeper as to why you should use a whole life insurance policy over a savings account. And I'll link that on the end screen here so you can watch it, because I think it's a really relevant video for you. So get to the end of this video, watch that video. But let's just assume you've come to the conclusion that a whole life policy is the place that you need to save your emergency fund. Well, when then does that whole life policy become your infinite banking policy? Because a lot of people buy them thinking they're buying an infinite banking policy and they're going to use it right away. But the bottom line is, your first job, if you want to be a good banker, is to capitalize your bank, right? And so a lot of people get into this and they think that they're going to have these immediate fast results, but the bottom line is it takes time for most people to capitalize their bank. Now, maybe you're somebody that's sitting with money in a savings account. You got 40, 50, 60, 100, 200 grand sitting in a savings account. There are things you can absolutely do to transition that money out of your savings account into a whole life policy, you're going to have an annual premium that will go along with it. So you make those deposits and you capitalize your banking policy even more. And if you are able to front load a policy, now you can be utilizing it for infinite banking for the most part right away, right? Because you have it capitalized, you have leverage involved in that. But ultimately, the first 5 to 6 years of your policy, you're not going to be earning positive arbitrage, because those are the highest fee years that you're going to have when it comes to your policy. There's no getting around that. You have to think long term. You have to realize that for even on the short term, if you're not earning positive arbitrage on a transaction by transaction basis, on a long term basis, you're setting yourself up to earn long term positive arbitrage, because you're never going to interrupt the growth of the money in your policy. And as you keep funding the policy, as you keep capitalizing that policy, as over time the fees in the policy go down and the policy becomes more effective, that's where you can start to achieve positive arbitrage in your policy, right? It's really, really that simple. It's just not going to happen right away. Now, those are the two different stages that it comes down to in your policy that I think everybody needs to understand. When you first start a policy, it is not a banking policy. It is your emergency fund. It is an opportunity fund. It is something that you sit there and you're building, you're capitalizing your bank. And whether it's an emergency fund or an opportunity fund is going to depend and be dictated by your life circumstances, right? Everybody's in a different environment. Your job security may be not impacted. Maybe you're a nurse and you have complete job security. So even in a down cycle and down economic environment, your job is completely safe. So you don't have to worry about this emergency fund as much, because the likelihood of you losing your job and needing it is not as high. But maybe you want an opportunity fund. But at the end of the day, I don't care what you call it, an opportunity fund, an emergency fund, rainy day fund, whatever. You have this account, you have your bank capitalized. So you got to go through that capitalization phase. Once that bank is capitalized, then you're able to implement banking practices. Now, I'm also a believer, you're not going to get rich buying depreciating assets. All these people that are saying you can make money on the cars that you buy, that's a lot of smoke and mirrors, honestly. There are elements of it, I understand, that are true. You're not making money on the cars that you buy, folks. What you're doing is you're simply operating more efficiently. You're not making money on that car. You are simply recapturing the money that you would be transitioning and paying to the bank. It doesn't mean you're making money. What you're doing is you're making your life more efficient. And so if it comes down to this conclusion of, or this decision of saying, I'm going to buy this car. I'm going to buy this car no matter what, right? Like, this car is something I want. Maybe it's like, maybe for me, it's a brand new like Ford Bronco. That's like my next thing that I want, or a Rivian or something of that nature, right? So like, I want to go get this Ford Bronco. If I know I'm going to get this Bronco anyway, right? Because it's actually for my wife. She wants the Bronco, quite frankly. And if I know I'm going to get this Bronco and I'm going to get it anyway, and that's just something that's there, I got to think about like, all right, I'm not going to make money on this, but if I'm going to finance it with a bank, or if I'm going to finance it with, or if I'm going to cash purchase it, which is basically self-financing, because when I spend the cash on that vehicle, I don't just spend the cash on it, I lose opportunity to have that cash earn money for me. So there's an opportunity cost of paying cash. And so I think a concept that everybody needs to understand, we finance everything in our life. We either pay the bank financing or we pay cash for it and lose the opportunity to have that cash grow for us. That is opportunity cost. That is what I call self-financing. We are now just losing that opportunity. That cash purchase is actually more detrimental in a lot of ways than paying low interest to the bank. But the other way to do this that I teach people to, and I'll link, check out the video up here talking about how to teach, how to explain infinite banking to a 10-year-old. It talks about becoming a wealth creator, right? And if you can be in a situation where you can never interrupt the compounding, you're gonna pay an interest rate, but you're always gonna have that money grow for you. So you're not gonna make money. I'm not gonna make money on this Bronco. I'm not gonna earn money, but I'm gonna reduce my transfer of wealth to another institution. I'm gonna keep control of my money. I'm never gonna interrupt the growth of that compounding, which is one of the keys to creating wealth, is never interrupting compounding. You don't ever wanna lose money or spend money unnecessarily. And that is ultimately what we're talking about, is never interrupting that compounding and recapturing that money that I would spend at the institution doesn't mean I'm gonna make money on that vehicle. It just means if I'm gonna spend money on that vehicle, I'm doing it in the most efficient way possible. I'm recapturing the money that I would have lost, which I guess you in turn could say I'm making money on it, but it's kind of semantics and it's a bit wordplay. And to me, it's just not something I'm comfortable like ethically saying that you're making money buying a depreciating asset. And so it's important. I get like the hype and like why everybody's doing it. It's just something, as I've thought more and more about it, I'm not comfortable kind of going there. But that said, that is the point though, is like when you hit the place where you are ready, you have your bank capitalized and you're ready to deploy that money for whatever it is, you get to decide how you want to use that policy. Do you want to use it for cars? Do you want to use it for college for your kids? Do you want to use it for cash flow hacking, buying real estate, cash flowing that real estate, using the cash flow to recapitalize a policy loan, pay back the policy loan, recapitalize the policy, right? Like that is the question. Those are the two different phases. Those are things you need to think about. If you haven't capitalized your policy yet and you have a bank, you have your banking policy, you need to understand that getting that first stage done first and doing it well and capitalizing it is absolutely vital to your success with your policy. Your behavior with your policy and your money and the principles and the filter in which you run your financial decisions through is absolutely paramount to your success when implementing this infinite banking idea. And so that's it. If you have any questions, comment in the comment section below. If you haven't already, make sure you subscribe and hit the bell. That way you're notified every time I launch a new video. The birds, thank you for being here. Until next time, have a blessed, inspirational day. We'll talk soon. See ya.